Have you ever considered the central contradiction of current U.S. economic policy? I mean, we have these aggressive trade barriers, right? They're specifically designed to revive U.S. manufacturing, protect American jobs.
Yeah, that's the stated goal. But
The evidence we're looking at suggests this very policy might be contributing to, well, a massive wave of layoffs and maybe even accelerating a critical pressure point on the dollar itself.
that's exactly the conflict we need to unpack here. The
Okay.
data, it's strongly suggests these tariffs, however well-intentioned they might seem on the surface, have fundamentally backfired in some key areas.
How so?
Well, they seem to be isolating traditional allies,
Hmm.
for one. And they're carving the U.S. economy into two really different worlds,
Yeah.
and maybe, ironically, strengthening our main technological competitor in the long run.
Okay, so let's break this down for you. Our mission here is to analyze three interconnected consequences. First, the scale of job cuts, it's actually quite shocking over the last 9 months. Second, this apparent tactical failure in the global technology battle. And third, the sort of unavoidable financial lever that it looks like U.S. policymakers are now being forced to pull, mainly to service the nation's skyrocketing debt.
It really connects the factory floor directly to the Fed, doesn't it?
It does. Let's jump right into the domestic side first, because the scale of these job losses is, well, it's staggering. From January through September 2025, the U.S. economy cut 950,000 jobs.
950,000.
Yeah. To put that in perspective for you, that's nearly 1 million jobs gone in just 3 quarters.
And what's really fascinating here isn't just the raw number, though that's huge. It's the context, this rate of decline. It's the most aggressive layoff cycle we've seen outside of, the two big historical shocks, the 2008 housing crisis and the 2020 pandemic lockdowns.
So much worse than usual slowdowns.
Oh, absolutely. Compared to just last year, the pace of layoffs is up 55%. This isn't some minor dip. It feels like an entrenched escalation.
And these aren't small, obscure companies either. We're talking about huge consumer-facing names you see every day. Amazon cutting 14,000 jobs, Target letting go of 1,800, Starbucks trimming almost 1,000.
Right. Big names.
But here's the really cruel twist, isn't it? The very manufacturing and auto sectors these tariffs were supposed to protect, they're being hit incredibly hard.
That manufacturing pain, it directly illustrates the economic bifurcation you mentioned earlier, this idea of two economies.
So explain that a bit more.
Okay, so you have GM, for instance, cutting over 3,300 EV workers from U.S. plants. Now, why would they do that when EVs are supposed to be the future? It's because we have this two-world economy emerging.
Right.
One world is, frankly, thriving. That's big tech, AI, certain strategic defense sectors. They're benefiting from massive subsidies being poured into things like chips, rare earth minerals, advanced computing.
Okay, the subsidized area.
Exactly. But then there's the second world, the part of the economy that actually uses physical inputs to create tangible goods. That's your Main Street businesses, traditional manufacturing, retail, even service industries like holiday agencies. They're contracting.
Because they rely on materials, logistics, global supply chains, all the things tariffs affect.
Precisely. Take that GM example again. They can't sell enough EVs made in the U.S., partly because the tariffs increase the cost of critical inputs. We're talking steel, specialized components, critical minerals. They all cost more now.
So the final product costs more.
Right. The result is that the U.S.-made EV price point is just too high. It can't compete effectively with, say, products selling for half the price in Asia.
So if the goal was bringing manufacturing home, why isn't the political system, pivoting, especially when the data shows this kind of immediate negative impact on jobs?
Well, that gets to a critical point about the actual mechanism of the tariffs. Our sources describe it as a triple squeeze.
A triple squeeze. Okay.
First, consumers obviously pay more for imports. That's the direct hit. Second, and this is key for the job cuts, companies facing higher input costs try to manage their margins. They might internalize some costs, but they also push back on wage growth or, more drastically, they lay off workers.
So the policy itself can act as a drag on wages or employment.
Effectively, yes. It can become a wage stagnation mechanism. And then the third squeeze is international. U.S. exports become significantly less competitive.
Because they cost more.
Exactly. Buyers abroad look at U.S. products, suddenly 15%, maybe 25% more expensive, and they choose suppliers from China or Vietnam, or maybe they just don't buy at all. It hammers export revenue. It's kind of a lose-lose structure in that sense.
This is where we need to look at the indicators carefully, right? Because unemployment figures, which people watch, they lag.
That's a classic issue. Unemployment is a lagging indicator. By the time those numbers really spike upwards, the underlying economic damage is often already quite severe. It means, the problem's already happened.
And are the leading indicators confirming this pain? The ones that predict future activity?
They absolutely seem to be. Despite all the trade barriers meant to spur domestic production, the U.S. Manufacturing Purchasing Managers Index, the PMI, it's still contracted.
Still below 50.
Yes, we're now in the 8th consecutive month below 50.
And just remind everyone, what does a PMI below 50 actually mean?
A reading below 50 indicates contraction, shrinking activity. The fact that U.S. manufacturing has been stuck below that threshold for 8 straight months, that really puts it squarely in the danger zone. It's a sign of pre-entrenched weakness.
So the intended policy outcome, reviving manufacturing, seems directly contradicted by these spiraling input costs. Steel, copper, aluminum, electronics, making U.S. goods too expensive at home and abroad.
That's the crux of the domestic problem. It's a structural cost issue.
Okay, that structural cost problem is devastating here at home, but as you said, it's only half the story. Let's pivot now to the global stage, specifically this technological rivalry, because this is where the policy failure might be even more strategically dangerous.
Yeah, we really have to acknowledge what looks like a significant tech policy failure internationally. Some sources are citing admissions from industry watchers that years of focused effort to, say, hobble competitors like Huawei, well, they basically describe it as a complete failure.
A complete failure. Wow.
They didn't just survive the pressure, they apparently came back stronger, achieving breakthroughs in advanced chips, really pushing indigenous development.
And what's fascinating there is the contrast in approach, isn't it? While the U.S. focused on sanctions, trade barriers,
China focused on relentless intentional industrial policy.
Yeah.
Everything from state-backed R&D on a massive scale to strategic workforce planning. And you see the results everywhere, even in consumer goods like the quality and affordability of BYD electric vehicles compared to Western counterparts.
So what's the consequence then for the U.S. tech sector specifically?
Well, one major consequence is stark isolation from a massive market.
Yeah.
Take NVIDIA, for example. Their share of the AI chip business in China reportedly dropped from something like 95%.
95%.
Down to effectively zero. And that market gap didn't just vanish, right? It was rapidly filled by state-backed domestic alternatives in China.
And China's reaction has been quite direct.
Extremely direct. Beijing has officially declared extraordinary measures to achieve total self-reliance in cutting-edge AI chips. They were already dedicating around, 3.35% of revenue towards high-tech R&D. Now they're mandated to double or even triple that spending.
So the sanctions actually created the motivation for them to become self-sufficient.
It certainly looks that way.
Yeah.
The U.S. policy essentially created a very clear mission for Beijing: stop relying on U.S. technology entirely. So the policy designed to limit Chinese tech advancement might have instead spurred them towards indigenous dominance while potentially isolating U.S. tech giants.
Okay, let's make the transition now to the financial pressure point. Because the fiscal consequences of this high-cost economy, the trade issues, it all inevitably ties back to the currency, to the dollar. We hear about tariff revenue, right? That $33 billion collected in October, often highlighted as a win. But what is that money really?
At the end of the day, it's simply a transfer of wealth. Consumers pay higher prices on goods, and that money flows directly to the federal government. But you have to see it in context. That $33 billion, it's frankly a drop in the bucket compared to the underlying fiscal challenge.
Which is
gargantuan debt servicing costs, just enormous.
And that number is truly terrifying when you look at it. The interest cost on the federal debt alone has now topped $1.2 trillion.
Trillion, with a T.
And if you add in individual state debt servicing, we're looking at over $1.4 trillion just in interest payments. And the average rate on that debt is an incredible 3.4%.
The sheer magnitude is the key takeaway here. That $33 billion in tariff revenue you mentioned, it barely covers the interest bill for a single month, maybe not even. This massive debt servicing cost leaves the U.S. economy with really only one viable long-term policy lever left.
Which is what? Cut spending drastically.
Well, that's politically difficult on this scale. The other lever is borrowing more money just to pay the interest, or dramatically reducing the cost of that debt.
Okay, so if the government can't realistically tax its way out of $1.2 trillion in annual interest payments, and default is obviously not an option.
The conclusion seems almost inevitable, doesn't it? They have to aggressively lower interest rates to slash that debt servicing cost.
That's the stark financial reality setting in.
It is. And we're already seeing signals of this potential pivot. The Federal Reserve, for instance, has halted its balance sheet reduction, quantitative tightening. That's a pretty significant indicator that they might be preparing for the eventual necessity of buying up bonds again.
A return to QE, basically, money printing.
A necessary return, perhaps, to expansionary monetary policy. And you're hearing this echoed in terms of political pressure, too. There are advocates now pushing for really drastic rate cuts upwards of 50 basis points, maybe more.
Which could lead to what?
It could lead to a rapid collapse in the Fed funds rate sometime in 2026. This isn't just economic theory anymore. It feels like a necessity driven by hard mathematical fiscal constraints.
And this kind of aggressive cutting, that's the definition of currency debasement, isn't it?
It absolutely is. It means the intentional reduction of the dollar's value, primarily to fix a domestic debt problem. Slamming rates down achieves several political goals, right? It lowers the government's borrowing costs, it weakens the dollar, which theoretically makes U.S. exports cheaper, and it allows companies to borrow more easily.
But all at the expense of the dollar's long-term purchasing power.
That's the trade-off. The value erodes.
So given that significant risk of debasement, let's look quickly at how investors are positioned. Since 2020, investors have poured, get this, an astounding $4.5 trillion into short-term money market funds.
$4.5 trillion. Wow.
And another $2 trillion into bond funds, mostly treasuries. These are massive bets on dollar-denominated paper assets.
And compare that. In sharp contrast, investment flows into historically proven hedges against currency devaluation like gold, only about $100 billion over the same period.
So $4.5 trillion plus $2 trillion, $6.5 trillion into paper versus $100 billion into gold.
The scale is completely disproportionate. People are piling trillions into short-term paper instruments precisely when the underlying economic reality seems to be forcing policymakers towards unprecedented monetary expansion and potentially devaluation. It suggests a fundamental unpreparedness for debasement risk.
Okay, let's try and synthesize this whole picture one final time for you listening. The aggressive tariff policy appears to have created a massive domestic cost and job problem.
Illustrated by that manufacturing sector witness, those 8 months in the danger zone.
Right. That cost crisis then seems to have exacerbated an already unsustainable debt problem.
Forcing policymakers toward that ultimate financial lever, aggressive rate cuts.
Which, by necessity, weakens the reserve currency.
Yeah, the options for maintaining the dollar's strength, or at least its recent strength, seem to be shrinking quite rapidly. The policy failures we discussed on the trade and technology fronts are now converging with this harsh fiscal reality, making some form of monetary intervention look almost unavoidable.
So the ultimate question for you, the listener, is this. When we see $4.5 trillion sitting in paper money markets, essentially betting on the stability of the dollar in the short term, yet the structural necessity points towards the government needing to aggressively devalue that same currency. What does that massive disparity mean for your exposure to debasement risk in the years ahead?
It really demands a reevaluation of where value is held, doesn't it? Given the economic role we've just described seems to be unfolding.